Gold just dipped, and everybody's acting like the party is over. In the last hour, spot gold slipped off the highs after printing a fresh record near $4,988, and you can already feel the "it's done" crowd crawling out of the walls. But here's the truth. This kind of pullback is not a reversal. It's a shakeout. It's the market's way of taking the weak hands off the train before it leaves the station again. And today, I'm going to do something most people won't do on camera. I'm going to show you my silver exit strategy for 2026, exactly what I'm watching, exactly when I'm planning to sell, and how I'm using gold at $5,000 as the anchor, without getting tricked by local prices, dealer premiums, or headline whiplash. Because if you're still thinking about silver like it's only a coin shop story, you're already behind. This is a global spot USD market story. This is a risk premium story. This is a ratio story. And yes, this is an Arctic tension story, so lock in. Quick note, I'm not your financial advisor. This is how I think about risk and timing. You do your own research and you size your position so you can sleep at night. Let's start with the why. Gold didn't dip because gold is weak. Gold dipped because the headlines cooled. We've been trading a geopolitical risk premium, especially around Greenland and transatlantic tariffs, and now the market is reacting to talk of a framework approach with NATO, which instantly softens that fear premium. When the fear premium fades, gold takes a breath. But here's the tell. Silver didn't collapse with it. Silver stayed stubborn. Silver held. Silver acted like a spring under tension. That matters, because when gold pulls back on news cooling, but silver refuses to fold, that tells me we're not looking at a normal safe haven trade. We're looking at something deeper, a structural bid for silver. One part is Western retail flow, ETFs and dip buying behavior. But the other part, this is the part people underestimate, is industrial urgency. Not, I want to own a shiny thing urgency. I need this metal to ship product urgency. And when those two bids meet, investment plus industry, you don't get polite price action. You get violent squeezes. You get gaps. You get the kind of candles that make people whisper manipulation even when it's just math, leverage, and limited supply colliding. Stop looking at local prices. Start with spot. I need you to do one mental reset right now. Stop anchoring your emotions to local prices. If you're in the US, you see eagles and maples. If you're in the UK, you see VAT and local premiums. If you're anywhere else, you see taxes, import spreads, currency effects, and dealer inventory games. Those are real, but they are not the control panel. The control panel is spot in USD. Spot is the world's clearing price. Spot is where the ratio is born. Spot is where the big flows decide what the next quarter looks like. And the reason I'm saying this in an exit strategy video is simple. If you can't tell the difference between a local premium spike and a spot breakout, you will sell too early, or you will panic too late. I'm not here to guess. I'm here to map the system. So here's the system. My 2026 exit strategy is not a date. It's a trigger. People want dates. They want calendar predictions. Tell me the month. Tell me the week. Tell me the day. No. My exit is not based on a date. My exit is based on triggers, because markets don't care about your calendar. Markets care about pressure. And in 2026, the cleanest pressure gauge is the gold to silver ratio. So let's talk ratio like adults. The ratio, the only moon math that isn't a meme. Right now, gold is the anchor. Gold is the lead singer. Gold is the heavyweight. And in a bull run, the ratio compresses. It doesn't expand. That means when gold runs, silver eventually runs harder. Why? Because silver is smaller, because silver is thinner, because silver is the metal where a little extra demand creates a disproportionate move. So here's my main framework. If gold hits $5,000 and the ratio is still wide, say 60.1, I'm not impressed, I hold. If gold hits $5,000 and the ratio is compressing, 41, 35.1, 31, now we're talking. That's the catch-up phase. The historical bull run compression target people talk about is 31, and that's not because 30 is magic. It's because in true metals, bull markets, the market starts pricing scarcity and substitution. Industry scrambles, investors chase, and the cheap cousin metal becomes the turbocharger. Now do the math with me. Gold at $5,000 and 31.1 implies silver at about $166. That's not a fantasy number. That's a ratio number. And ratio numbers are the kind of numbers institutions can't ignore because they show up in models, in hedges, and in rebalancing decisions. So when people ask me, why are you not selling at 95? Because I'm not trading a number. I'm trading a compression. How I actually track the ratio without losing my life to the charts. When I say watch the ratio, I don't mean stare at it like a hypnotized rabbit. I run it like a dashboard. Step 1, I anchor to spot gold in USD. Step 2, I anchor to spot silver in USD. Step 3, I divide. That's it. No mystical indicator, no secret setting. just the relationship. And here's a practical rule that keeps me sane. I don't care about the ratio wiggles inside the day. I care about the weekly behavior, because intraday moves can be noise, especially when algos are hunting liquidity, but weekly closes tell you what the market is committing to. So I use 3 ratio zones like lanes on a highway. Wide lane, 61 and above. Silver is underperforming gold. It's usually early cycle or fear-driven gold leadership. Mid lane, 51 down to 41. Silver has started catching up. Volatility increases. This is where you plan your first real scale-outs. Compressed lane, 41 down to 31. This is the danger zone, in a good way. It's where silver starts acting like a rocket and where your emotions will try to sabotage you. And right now we're sitting in that mid-lane territory, hovering near the low 50s by the math of the current spot levels, which is why I'm not calling the top at $95, I'm calling it setup. Why silver can outrun gold even when the headline cools. Here's the counterintuitive thing that confuses people. Gold can be down on the day, and silver can still be building a base. Because gold is mostly a monetary asset. Silver is monetary plus industrial. So when the geopolitical risk premium eases, like it did when the Greenland talk shifted toward a framework, gold can give back some fear premium. But silver has another engine humming underneath. Contracts, production lines, and industrial planning cycles. A factory doesn't cancel demand because a politician used a softer word. A procurement team doesn't stop planning because the headline tone changed. This is why I keep saying, silver is function, and function demand doesn't turn on a dime. This is why I keep saying, silver is function, and function demand doesn't turn on a dime. That's what creates the resilience you're seeing. Fear premium can come and go quickly, but function demand creates sticky floors. The 3 phases of a metals bull market, so you know where we are. This is the mental model that stops you from doing something stupid. Phase 1. Disbelief. Price rises, but nobody believes it. People explain it away. They say it's temporary. They say it's just news. They say it's just a squeeze. Phase 2. Chase price keeps rising. The same people who mocked it start buying. Media coverage flips from bubble to new era. Pullbacks get bought aggressively. Phase 3. Mania. Everyone becomes an expert. Your barber tells you a price target. Your cousin who never invested sends you screenshots of silver futures. The conversation stops being why and becomes how high. Where are we now? Gold looks like it's entering late phase 2 because the targets being floated are now openly above $5,000 for end 2026. Silver looks like it's early phase 2 because it's still fighting the psychological ceiling of $100, and the public still thinks $100 is crazy. That's the sweet spot, because you want to buy in disbelief and sell into mania. You don't want to buy into mania and sell into fear. So my exit strategy is built for phase 3, before phase 3 arrives. My moon math scenarios, realistic, not fan fiction. Let's run 3 scenarios so you can see the logic. Scenario A, conservative compression, gold, $5,000 ratio, 41.1, silver, so 125. What it feels like, silver is strong, but still explainable. This is where I sell a meaningful chunk because the market is rewarding the thesis. Scenario B, full bull compression, gold, $5,000 ratio, 30.1, silver, 166. What it feels like, silver is not polite anymore. Daily swings get bigger, premiums expand. People who ignored it suddenly always loved silver. This is where I take serious profits because the catch-up move has completed. Scenario C, gold overshoots the $5,400 case. Gold, $5,400 ratio, 30.1, silver, 180. Now you see why I call $5,000 a conservative anchor. The overshoot scenario is literally what some forecasts are pointing to. In that world, you don't need to be perfect. You need to be positioned. And you need an exit ladder so you don't freeze when the number finally arrives. The most important part, your size. Let me say something that will save you. If you can't survive a drawdown, your thesis doesn't matter. I don't care how right you are. If your position size makes you emotional, you will sabotage yourself. So before we talk about selling at 125 to 150 or 166, you have to decide how you're going to behave at 85, because volatility is not a bug in silver. It's the feature. And in 2026, volatility is going to be the weapon that transfers inventory from weak hands to strong hands. So my personal rule is simple. I size my position so that a violent dip feels annoying, not life-ending. That's what lets me hold for the ratio. That's what lets me follow the ladder. That's what lets me exit like a professional, not like a gambler. The 3-layer. Exit ladder, how I scale out without being a hero. Now I'm going to give you the exact ladder. Not sell everything at the top nonsense. Not diamond hands forever nonsense. A real ladder. because real investors don't try to nail one perfect tick. Real investors manage exposure. Here's my ladder for 2026. Layer 1, confirmation trim, 10-20%. Trigger, silver breaks and holds triple digits on spot, clean close above $100, followed by a retest that holds. Why I trim? Because triple digits is psychological. It's where media attention explodes. It's where new buyers arrive late. It's where volatility spikes. What I do with the trim, I don't run to buy a new car. I build the war chest. Cash is a weapon when markets get wild. Layer 2, ratio compression sell, 30-50%. Trigger, gold is above $5,000 and the ratio hits 40.1 or better. This is the big one. Because if we're at $5,000 gold and 40.1, silver is roughly 125s. And at that point, the story isn't maybe. The story is it's happening. So I scale out a meaningful chunk, not to abandon the trade, but to remove emotional pressure. That's the secret. Take pressure off your mind and you make better decisions. Layer 3, mania exit, remaining core. Trigger, ratio approaches 30.1 and silver is behaving like a mania market. Daily spikes, constant headlines, premiums going insane, and everyone suddenly becoming a metal expert at family dinner. That's when I take the rest off in stages, not one click, stages, because manias don't end with a gentle whisper. They end with a scream, and I don't need to be there for the scream. Why $5,000 gold is my anchor, and why it's not crazy. Now let's address the elephant. $5,000 gold? Isn't that extreme? Listen, major banks have already started talking about targets above $5,000 for the end of 2026. So my $5,000 anchor is not a lottery ticket. It's a conservative checkpoint. It's me saying, if the world is willing to reprice gold to $5,000, the ratio compression trade becomes a high probability environment. Because if gold is that high, something is happening in the background. Central banks are buying. Investors are hedging policy risk. Confidence in paper promises is degrading. And real assets are becoming the default language again. And that environment is exactly where silver stops acting like a hobby and starts acting like a bottleneck. The Arctic tension narrative. Why Greenland headlines move metals. Now let's talk about the part everyone thinks is just politics. Greenland, Arctic shipping routes, tariff threats, NATO framework language. This isn't gossip. This is macro plumbing. Here's the simple version. When major powers signal trade fragmentation, investors price in supply disruption and currency risk. That's bullish for gold. But for silver, it's double impact. Safe haven demand rises when the world feels unstable. Industrial urgency rises when supply chains look like they might snap. That's why silver can stay strong even when gold pulls back on cooling headlines. Because silver isn't only fear, silver is fear plus function. And in a world where the Arctic becomes strategic, you get more defense spending, more electronics, more infrastructure hardening, more demand for conductivity. That's why I watch the Arctic narrative not as drama, but as a signal. It tells me whether the premium is expanding or being temporarily dissolved. And when it dissolves, I look for one thing. Does silver stay bid anyway? If yes, it means the floor is not just fear, it's physical demand. The supply deficit, why silver acts like a spring. Now we get to the backbone of the thesis. Silver has been running a supply deficit cycle for years, and deficits are quiet until they are not. A deficit doesn't explode on day one. A deficit builds tension. It drains available inventory. It makes delivery more important than price. And then one day, the market flips from available at a price to price doesn't matter, availability does. That's when you get allocation. That's when you get delays. That's when the real game begins. AI data centers are not slowing down. Solar build-outs are not slowing down. Defense and electrification aren't slowing down. And all of that runs through the same thin pipe, silver. So when I say exit strategy, I'm not saying I hate silver. I'm saying I respect the possibility of a blow-off top, because if a metal is a bottleneck and everyone suddenly realizes it at the same time, prices don't behave. Paper versus physical, why your exit has two prices. Here's where people get blindsided. In a real metals bull market, you don't just have the price. You have two prices. The paper price, spot, futures driven. The physical reality price, premiums, availability, delivery time, allocation. Most viewers only track number one. But the exit strategy has to respect both, because if the paper price screams higher while physical supply gets tight, you can see something weird. Paper prints one number, your dealer quotes another, and delivery windows stretch. That doesn't mean the market is broken. It means the market is revealing a truth. Paper trades instantly. Atoms do not. So my exit approach in 2026 includes a reality check layer. If paper silver is at $120, but physical premiums are acting like a shortage, meaning the street is paying $140 equivalent after premiums, then I know the stress is real. And when stress is real, the move can extend, but it can also snap back violently. So I do two things. I don't wait for the perfect number. I respect the latter. I don't ignore premiums. Premiums are the smoke that tells you the fire is spreading. Now, I'm not telling you what to buy or how to store anything. I'm telling you how to read the signals so you don't get tricked. The shakeout playbook. What I do on days like today. Let's talk about a day like today. Gold hits a record, then pulls back as headlines soften. Here's what the crowd does. They see red and assume top. They sell into fear. They promise to buy back lower. They never buy back. Here's what I do instead. Step 1, I ask, did the structure break? Not the candle, the structure. Are weekly levels broken? Is the ratio widening aggressively, or is it just noise? Step 2, I check the tell, silver relative strength. If silver is holding while gold dips, I treat it as a warning to shorts, not a warning to holders. Step 3, I zoom out and remember the thesis. If the big target for gold is still in play and forecasts are being revised upward, then a $60 dip is not the end of the era. Step 4, I preload my actions. I set alerts for the ladder triggers. $100 hold, 40.1 compression, 30.1 compression, because when the market moves fast, you don't have time to think. You have time to execute. What if I'm wrong? This is how I stay credible. I always include this because it's the part that protects you. What if gold doesn't hit $5,000? What if the ratio doesn't compress? What if the dollar rips and metals pause? Then my strategy doesn't become panic. It becomes time. Because the exit ladder is triggered by conditions. No conditions, no exit. And if we enter a long consolidation, I do 3 boring things that win. I stop staring at 5-minute charts. I focus on weekly closes and ratio trend. I keep dry powder and patience. Most people lose because they can't tolerate boredom. They need action. They need drama. But wealth is often built in boredom and realized in mania. The one mistake that destroys silver winners. If you take one thing from this entire video, take this. Don't turn a winning thesis into a leverage bet. Silver already moves like leverage. If you add leverage on top of leverage, the market will eventually find your breaking point. And the tragedy is, you can be right on the direction and still get wiped out on timing. So my exit strategy is built around staying alive long enough to see the ratio targets, not around chasing adrenaline. The real exit question, what am I rotating into? Okay, sell into what? This is where people get it wrong. They sell a hard asset into a weaker paper asset. At the exact moment, paper is losing credibility. So I rotate with intention. My rotation list is simple. Cash, short term, for optionality and to buy corrections. Land or productive assets, long term, for stability. A core position in gold, always as the anchor. And sometimes, if the ratio overshoots, rotate some silver into gold. That last one matters, because sometimes the best sell isn't selling into dollars. It's swapping metals when the ratio gets extreme. If silver goes full mania and the ratio compresses too far, I'll consider trading a portion of silver into gold, because gold tends to be calmer on the other side. Again, not advice, just the framework. Since the market is staring at PCE and rate expectations, here's the practical checklist I use on days like this. Before the number, I don't make emotional decisions. I set alerts and I accept volatility. Watch the dollar. First, if DXY pops, metals usually flinch. If DXY fades after the pop, that's a tell the market wants higher metals anyway. Watch real yields. When real yields cool, gold breathes. When real yields spike, the shakeout intensifies. If PCE is hotter than expected, the dollar can spike, metals can dip, and headlines will scream, "Gold is done." I treat that as a stress test, not a verdict. If PCE is cooler, the rate cut narrative strengthens, and metals often catch a bid fast. I watch the ratio because silver can launch after gold confirms. After the first move, I wait for the second move. The first move is often a trap. The second move tells you positioning. End of day check. I care how we close. A scary intraday wick means nothing if the week closes strong. Execution rule, I don't hunt the candle. I let my ladder do the work. I set alerts at $100, then at ratio landmarks, and I act in planned tranches because speed kills decision making. Mindset rule, if you feel your heartbeat in your throat, you're overexposed. The market's job is to make you feel. Your job is to follow the plan anyway. And through all of it, I keep one final rule. I never let a single data print override a multi-month trend. Data sets the tempo. Structure sets the direction. Ratio sets the exit. If you missed a move, don't chase it out of pride. Wait for the retest, wait for the ratio signal, and remember, cash is a position when the screen is screaming. The two things that can delay this plan. Now, credibility requires risks. Here are the two biggest delay risks I'm watching. Risk 1, dollar strength, DXY. If the dollar index rips higher and holds, it can delay the next leg. A stronger dollar tightens financial conditions and pressures metals in the short term. I'm watching key levels and the behavior around them because the dollar doesn't need to win forever. It only needs to spike hard enough to cause a shakeout, and shakeouts are the point. Risk 2, PCE inflation and Fed expectations. The market is waiting on PCE and other key data because that dictates rate expectations. If inflation surprises hot, rates stay higher and the market can pause. If inflation cools, the rate cut narrative returns and metals breathe fire. So the way I trade this mentally is, data decides the pace. The ratio decides the exit. My if-then decision tree, the part you can copy. Here's the decision tree I use so my emotions don't hijack me. If gold dips on headline cooling, then I check silver behavior. If silver holds while gold dips, then I assume the bid is structural and I do not panic sell. If silver breaks $100 and holds, then I trim 10-20% to create optionality and reduce stress. If gold reaches $5,000 and the ratio is still wide, then I hold core silver. If gold reaches $5,000 and the ratio hits 40.1 or better, then I scale out 30-50% in planned increments. If the ratio approaches 30.1 and the market turns manic, then I exit most of the remaining position in stages, and I consider swapping some silver into gold. And at every step, I do one thing most people don't do. I write it down before the candle forms. Because the candle doesn't ask permission, it just happens. And if you're improvising, you lose. What I want you to do today. Here's your homework. Stop watching only local prices. Start watching spot USD. Put the ratio on your screen. It's your compass. Decide your trim points before the market forces a decision. If you can't handle a 10% move, you're oversized. Fix that before the mania arrives. And if you want to play this like a professional, do this one extra thing. Watch how silver behaves on days when gold is red. That's where the truth leaks out. Because if silver refuses to die on bad days, it's telling you something. The market is building a floor.